everyone, welcome to Sector Focus. This is Aanchal Pathak here, and today I am going to give you an in-depth understanding of the IT sector. The Indian IT sector has surpassed all expectations and has continued to outperform. While the valuations may appear to be stretched thin, earnings upgrade cycle is yet to peak and the sector may continue the momentum for the rest of the year. We expect Q2 earnings to be better than the record showing in Q1. IIFL Securities expect 5.3% QoQ USD revenue growth, primarily led by strong demand and deal ramp-ups despite 70 basis points cross-currency impact. EBIT margins are expected to be stable as increased costs for new hiring and wage hikes will be offset by high growth, absence of visa costs, and pandemic-led cost savings. The revenue growth forecast for FY22 is 19%, for FY23 is 14%, with a further upside risk as budgets for 2022 become clear. Why is there still a potential for further increase? Despite a flat growth curve for the IT services sector in the year 2020, the high rate of digitization and structural technology upgrades of around 4% has boosted the sector in the year 2021. During this period, the increased upgrade in operating profits has done more than offset the losses incurred in 2020. The primary catalyst for this has been the pandemic. Due to the decreased timelines given by clients for their digital transformation, the competition among the digital leaders has increased substantially. Thus, demand for IT and deal pipeline have remained strong, leading to lasting growth. We see a 7.9% CAGR in annual contract value for traditional sourcing and 24.7% CAGR for software as a service. Gartner expects a high single-digit spending growth over the next 5 years versus mid-single-digit growth in the preceding 10 years. We can expect an 820 BPS increase in spending growth rate for FY21 owing to increased digitization. While demand seems to be extremely strong across companies, supply remains a challenge and Q2 growth could have been even stronger if not for all the supply-side issues. All companies apart from Tech Mahindra have announced 2 rounds of wage hikes over the last 9 to 12 months. From a net hiring versus revenue growth perspective, in the large cap coverage, Tech Mahindra has the widest gap, which implies that they would need to step up hiring in the next few quarters. Let's see the outlook for the top 5 trending IT shares. Analysts forecast an 8% upside potential for TCS shares. Revenue growth has been very strong with an increase of 4.60% from last year, and this growth has been constant throughout, further strengthening our prediction of a high growth trend for the next 5 years. Past 3 CAGR for net profit is 12.17%. We forecast a revenue growth of 5.5% quarter on quarter, supported by a strong demand environment. Given the lack of wage hikes recently, we forecast a 70 BPS growth of EBIT margin quarter on quarter. Investors should keep a tab on the demand environment and its sustainability, pace of deal conversion, and attrition trends in the industry. Analysts forecast a 22% upside potential for Infosys shares. A 6% quarter-on-quarter revenue growth is forecasted for Infosys due to the continued ramp-up of large deals being won, like Daimler, should keep this momentum healthy. Customers have continued to track their digital journey, thus supporting this momentum. The operating leverage or EBIT margin from a very strong growth is being offset by high wage hikes given to all the employees by the company. The EBIT margin is expected to contract by 90 BPS due to this. But the new hiring is reaping its benefits slowly, and the high transition costs for the large deals are also helping in bridging the gap. Huge leap of the EPS from 38.97 in 2020 to 45.61 in 2021, signifying higher earning potentials in the future too. Analysts expect 10% upside for Tech Mahindra shares. A 5.5% quarter-on-quarter revenue growth is expected due to the benefits arising from the Telefonica deal and a broad-based growth. The EBIT margins are further expected to grow by 20 BPS due to anticipated strong revenue growth. Investors should watch out for status of the 5G deals and the trajectory of the deal wins in the next few quarters. The EV/EBITDA of this stock is 11.32 as of 2021, which is overvalued. Analysts forecast a hefty 27% upside potential for Persistent Systems share. An 8.2% revenue growth is expected as all the segments strengthen. Mainly as impact of the wage hike and increased hiring, the EBIT margin is predicted to contract by 80 bps. The PB ratio has shown a drastic increase in this stock too, with a whopping increase of 196%. The quick ratio has also shown a moderate increase of 40 bps. The 3-year CAGR of EBIT is approximately 38%. Analysts forecast 9% correction in Wipro. We forecast 7.8% quarter-on-quarter growth in Q2, above its guidance range of 5 to 7%, aided by 1 month of revenue from the Capco and 2-month contribution from Ampion. However, we expect EBIT margins to contract 100 bps quarter-on-quarter due to impact of wage hikes. We expect Wipro to guide for 2 to 4% QoQ growth in Q2-FY22. Investors should watch out for progress on cross-selling opportunities from Capco, quantum of deal wins and color on the deal pipeline, and thirdly, impact on supply side due to high attrition.